Welcome to the AAA Storage Podcast, your integrated real estate and development partner exploring all things self-storage investing to bring you diversified success. Let's dive in. Hello, and welcome back to another episode of the AAA Storage Podcast. I have with me, as always, the inimitable Paul Bennett. Thank you for joining again. And we have a featured guest today in Paul Shannon. Now, Paul Shannon, you are an expert in real estate. You host your own podcast. I would love if you could tell our listeners a little bit about yourself, and we'll talk today about what's going on in real estate from your perspective.
That sounds great. Brandon, Paul, first of all, thanks for having me on the show. I'm looking forward to our conversation. Sure, a little bit about my background. I've been investing both actively as a multifamily and single-family operator, as well as a passive investor since 2016. I found that actively, sometimes profits are higher, but the workload is quite heavy, right? Yeah. Sometimes there's more risk. As a passive investor, I've enjoyed being able to diversify my capital outside of my local area of knowledge, outside of my local geography, and into other asset classes that I don't have experience in. Those asset classes, to name a few, also multifamily in other areas of the country, industrial assets, self-storage, mobile home parks, private equity businesses, industrial assets. I've invested up and down the capital stack, that being debt, preferred equity, common equity. So a wide variety of experiences. I'm a passive investor in over 40 deals. I have done a lot of renovation on heavy value add multifamily residential units, upwards of about 200 units. And, just am really interested in the space. I always like to try to stay up to speed on what's happening in the world of economics and the economy and, the global kind of how all the pieces fit together, so to speak, and how they connect to the real estate world. So it's been a good journey. And as of late, I'm also the co-host of the Passive Pockets website, Passive Pockets podcast, excuse me. Passive Pockets is a community of passive investors that come together to kind of share knowledge, help each other, vet sponsors, and understand the industry, stay away from the bad actors if there are any, sort of a word-of-mouth type approach, but just a strong community to kind of get other people's opinions to make sure that you're on the right track as a passive investor. So that's been a fun experience too.
Yeah, that's right. Great. Thank you so much. Yeah, definitely check out the Passive Pockets community and the podcast that Paul helps host. The AAA Storage team is members of that community and would love to interact there as well. Definitely a great resource for all your real estate investing needs. Paul, before we get started, Paul Shannon, there's two Pauls. I gotta clarify. Paul Shannon, tell us how do you define passive investing? What does that mean to you, or how would you describe it to somebody?
Sure, that's a great question. When I think of passive investing, the first phrase that comes to mind is mailbox money, right? I alluded to it when I was introducing myself there, that there's active investments, and those are ones where you're the active operator, you're in charge, you're the manager of a project, so to speak. You own the real estate. Maybe you hire a third-party property manager, but you are, interacting with brokers, trying to source deals, find deals, come up with the value-add plan if there is one, source the debt, basically hold the property and service it during the period that you own it. As a passive investor, it's a different approach. I wouldn't say it's completely passive. I think people sometimes make that mistake that they can just hand their money to somebody and they'll take care of it as a fiduciary. The work really is on the front end for a passive investor, and that's identifying people that you know, that you like, that you trust, that are competent in the space that you're interested in, and they are going to be able to execute their business plan. But once you make that decision and you subscribe to their offering, and you hand over your money, that's where you sort of are out of everything from there on out is out of your control. It's in the active partner of that business's, hands at that point to control your capital and execute their business plan and ultimately, arrive at those returns that they were targeting on the front end. So at that point, when I say passive, that's where the mailbox money comes in. If everything goes to plan, that's where you start getting checks in the mail for your distributions. And when the asset is eventually sold, hopefully you're going to be enjoying the profits as well. But you don't really have any active involvement from the time you wire the funds until the time you get it back at the end.
I love that. That's perfect. Thank you. Yeah, we spent a lot of time on that front end doing that kind of due diligence and showing, why especially the AAA storage team goes into certain investments, or the way that they, think about the process, think about their own due diligence in order to kind of build that trust and help investors walk through that process. Because to your point, that is the activist part, at the very beginning from an investor as a passive investor.
100%. Just to add to that too, is that you really need to put more emphasis on the sponsor, their experience and their trustworthiness than you do necessarily the deal. We always talk about it in the Passive Pockets community that a bad operator can mess up a good deal or even a great deal. A good operator or a great operator can make a bad deal into an okay or even a good one. So getting the sponsor right is the most important thing as a passive investor.
I like that. That's helpful. Okay, well, shifting gears a bit, I want to get into some of I know you're tracking markets and economic analyses and things like that pretty closely. So Paul Bennett, before we started recording, you talked about this article that you found very, very helpful to understand a trend that is developing in your world. Can you describe that article a little bit? And then I'll let you guys kind of take it from here as the real estate experts. I don't want to jump in too much.
Absolutely. First of all, Paul, Shannon, I'm thrilled to have you on the podcast with us. Man, I've got so much respect for you, and you have a unique seat in the passive investing world and an ability to sort of see the market from a perspective that a lot of people don't. And so I really, really value your information. We were talking before we started. I just read an article recently. It was published by one of the big fund administrators. So they have sort of a unique view of capital being raised and that type of thing. And it had some interesting statistics in it. One of them was that the current market for private equity is about $25 trillion. And it's projected to more than double between now and 2032, where it's projected to be about $60 trillion. I can't even wrap my head around that number. But the other comment that I found fascinating was that a lot of that growth is being driven by the entrance of high net worth individuals into the private equity markets, and in particular in real estate. So I'm just curious if you're seeing that sort of migration of people that have traditionally invested in ETFs or equities, or suddenly beginning to consider adding alternatives to their portfolios, or what do you see sort of at the broadest level of the market?
Yeah, I mean, I definitely wouldn't disagree with that article. I think the space has grown dramatically and is going through a maturation process as we speak. In 2012, the Tax Cut and Jobs Act was enacted, and that really paved the way for syndications and private real estate, private investment in general from high net worth individuals. And then in 2017, that act was revised during Trump's first administration. And since then, the space has grown dramatically. I think there's a couple factors there. One is that there's a lot of people who are looking for more control in their portfolios. And most people prior to that time period were really allocated heavily into stocks and bonds, traditional markets, right? And as much as your financial advisor will tell you that you're diversified, it sure doesn't feel that way when everything's moving in the same direction down. If everything's going well and it's going up, you're not too worried about it. But when everything's going down in tandem, like it was in 2020, for example, and then even bonds that are supposed to be the safe haven, provide income and sort of reduce volatility in a portfolio started going sideways, you start to feel out of control. So I think a lot of people that I talk to are attracted to the alternative space, specifically real estate, because the collateral is so strong in the underlying asset that you own, that, are looking for a little bit more control and consistency and diversification, true diversification in their portfolios. So that's one thing. And then as it relates specifically to real estate or commercial real estate, I think people are realizing that they don't have to be active landlords. It used to be that there's a phrase out there that if you're going to get involved with rental properties, it's got to be single family homes, and you're going to have to deal with tenants and termites and toilets and 2 a.m. phone calls and all this stuff. And that may have been true at a certain point, but now with passive investing, you can put your capital in the hands of responsible folks like AAA Storage and many others that are out there in different asset classes who have been doing their specific niche in the space for decades. And they do the work for you, basically. So it's really just identifying who those people are. And, real estate has some very specific and very unique characteristics to it that are different than stocks, bonds, and traditional assets. There's an acronym that I like to reference. It's IDEAL. IDEAL stands for I, income. So the properties that you own produce income. D is for depreciation. So you're getting some tax benefits from these assets. E is for equity buildup. That's where the tenant is actually paying down the debt that you originate in the note, and they're servicing that note basically through their rent payments. A is for appreciation. So these assets tend to appreciate over time. Real estate is shown to appreciate oftentimes at greater rates than the stock market. And then L is the use of leverage, and that's twofold. One is leverage, meaning debt. So when you borrow fixed rate debt in an inflationary environment, the cost of that debt in real terms actually goes down over time, because as inflation makes the dollar worth less, so are the dollars that you borrowed, say 5-10 years ago. They're worth less today. If you borrowed $1,000 today, in 10 years, that $1,000 isn't worth the same, right? But you still have to pay back that $1,000, which is not as much of a debt burden. So that's one point of leverage. And then the other is, again, going back to leveraging other people's expertise and experience and, and the operators that you invest with as a passive investor. So all those things make for a very unique investment opportunity. In my opinion, multifamily, self-storage, these commercial real estate assets are some of the best asset classes in the world to get involved in. And now there's just more access to it. So that the space is definitely growing.
Yeah, that's really good stuff, Paul. We've talked with a number of registered investment advisors, and we've got a whole group of them that have recommended opportunities with us to their clients. But I often found in that market that they're so oriented on ETFs and equities and mutual funds that it almost blows my mind, because I think any high net worth individual should have an allocation to tangible real assets in their portfolio. So I agree with you. And the lack of correlation of the public markets is one of the biggest reasons why. I totally agree with you. That's really great stuff.
100%.
I'm going to steal that ideal.
Yeah, please do.
That's pretty good.
I stole it from somebody else, so I can't take credit for it. But the correlation piece is huge, and you feel it today, especially when the stock market's kind of on a decline. There's talks about a recession happening, et cetera, et cetera. I'm sleeping better at night during a volatile period than I ever have in the past. My allocation to public markets is as low as it's ever been, and I'm happier than a clam to be where I am right now in real estate position. So for sure.
Yeah, absolutely.
So, Paul, I wonder, Paul Shannon, I wonder if you could tell us a little bit about how you're seeing markets play out right now and things that you are paying attention to in the near term, let's say the next 6 months, next 12 months. What are some things that you're trying to follow on? Are there particular, influencers, economists, market analysts that you're following or reading, or how are you staying on top of things right now as they're developing? Because there is some turmoil right now. I think the last month or so, folks have felt a little uneasy about the way that the market is headed, based on whether it's trade policy or treasury rates or just the general stock market. So how are you seeing things right now, and then how are you keeping up with those developments?
Great question, and I'll try to keep this short because I could really go on a tangent here, but. A lot of times headlines are clickbait, and they're sensationalized, and they're meant to get people excited or to panic or whatever to get readership, right? So I try to eliminate emotion the best I can when I'm keeping up with current events. But I do also believe that the macro environment is critical to being able to invest effectively. And I don't want to say that I try to time the market. I certainly have failed at that plenty of times in the stock market, trying to pick hot fads or predict when the market would go up or go down, and been wrong almost every time. Real estate tends to move much slower, where the stock market can act like a roller coaster. The real estate market acts more like a Ferris wheel. So there's specific cycles. And these cycles could be independent of, different markets across the country based on supply and demand and, population growth and jobs and what's driving, the growth in the market, et cetera. So, trying to keep up with those things in real estate, I think, is a little bit easier because it moves a little slower, and you can kind of follow these macro trends and attach to a thesis and sort of ride it for a little bit longer than the stock market where things happen very quickly. There's algorithmic trading, and there's sentiment that's involved that's much stronger, and emotions. And you can just go onto your computer and click a button, sell and trade and do all these things. It's a little bit different in real estate, where you're locked into a pretty illiquid asset. So I will say that. But there has been a lot of turmoil, so to speak, in the real estate market in general, commercial real estate over the last 3 or 4 years. And I follow multifamily very closely, and just briefly touching on the past 5 years or so since COVID happened, we expanded the money supply by almost double, which created an inflationary environment. At that time, the Federal Reserve was saying that all that money wouldn't really impact inflation, and any price changes that we saw at the grocery store counter or any of these other stores that you go shopping in where you see these prices go up, it's just going to be transitory. It's going to be semi-permanent, but it'll go away on its own. And that narrative started to lose credibility around late 2021 when inflation was at about 9% and the federal funds rate was still at 0. They probably didn't raise rates soon enough, but they started to identify and recognize that inflation was a little bit more structural than transitory. So Jerome Powell and the Federal Reserve started telegraphing that rates were going to go up. And if you look back at history, the last time inflation was as high as it was at that point was back in the 1980s, and the Federal Reserve chairman at that time was Paul Volcker, and he's credited with breaking the back of inflation. Well, how he did that is he raised interest rates, the federal funds rate, significantly and quickly. And at that time, I've got stories from my parents and my uncle. They bought homes and they had interest rates of 15% on their houses at that time. So just those stories anecdotally and what was happening in the market kind of had me a little bit concerned. And interest rates heavily impact commercial real estate because they're not correlated one-to-one with cap rates or capitalization rates, which is the multiplier that's used to value commercial real estate based on the income a property produces. Not correlated one-to-one, but they are heavily influential with one another. So if interest rates go up, typically in historical terms, cap rates tend to expand, and cap rates are inversely related to the price of real estate. So if cap rates go up, property values go down and vice versa. So my thesis going into 2022 was that, we're going to see downward pressure on real estate prices. First of all, they had gone through the roof. So what goes up often comes down hard. And then you had this phenomenon with interest rates going on, the correlation between cap rates. We kind of really backed off of commercial real estate at that point. And it was difficult to acquire. We tried to. We made offers based on what we thought made sense. But there was still sort of this irrational exuberance in the marketplace, and a lot of people were paying top dollar for assets. And they were doing it using short-term bridge debt, floating rate debt, which, if it's floating, it moves. It's like a variable rate mortgage. And when the federal funds rate was going up, these mortgages that were now on these commercial properties started going up. So it was eroding cash flow, rents started to stagnate, and that brings us up to really today where a lot of these loans are starting to mature, and you're seeing some distress in the marketplace where these operators anticipated that their net operating income, the income the property produces, was going to be X, and it's much less than X. They've also got much higher borrowing costs, so they have to actually bring more cash to close or get that loan refinanced, and property values have fallen. So what's happened is that if you were a active real estate investor or passive real estate investor in some of these deals, you've lost some capital. And, hey, you lose capital in the stock market, right? We take risks when we invest. But some of these risks that we're taking were outsized, and that's part of the maturation process of the industry. Why I summarize all this is because now what I'm seeing is that we've sort of reached peak rates, right? The federal funds rate has actually come down 100 basis points since September. Now, for a while there, the 10-year Treasury was moving in the opposite direction and going up, almost, correlated one-to-one. It moved up 100 basis points, which is a weird phenomenon. That hasn't happened since, again, the 1980s. 6 or 7 of the last rate hike cycles that have then turned around and sort of been cutting, that has not happened. And so this is sort of a one-off type scenario. The good news is now the 10-year is starting to fall down again, and that 10 years where a lot of the borrowing rates are based off of. So as debt becomes cheaper, that infuses more capital into the space. There's more predictability around what's going to happen with interest rates. That's good for commercial real estate. Mm-hmm. So that's what I've been keeping my eye on. And for the first time in about 3 years, I'm starting to see that deals are starting to pencil again. They're starting to make sense. They're starting to look attractive. And although the stock market and some of the headlines you read in the papers are going to say the exact opposite of what I'm saying, now is actually a good time to buy commercial real estate, in my opinion, because the dust has sort of settled and we've already seen some of the decline. And now we've got, a very difficult environment for getting stuff out of the ground and building new stuff, but there's still a lot of demand from tenants, let's say. And I'm talking in broad terms, that could be tenants of the products you guys produce for self-storage, or tenants that want to go live in apartment buildings. But there's not a lot of supply that's going to be available in the next year or two. There was for a few years, but that's starting to dry up now. And when there's low supply and high demand, that's typically good. With low borrowing costs, that drives investment into the space. So even the stock market could be doing poorly. That doesn't mean commercial real estate's going to be doing poorly. The stock market's actually been doing great the last few years, right? And commercial real estate's been a little bit more challenging. So to your point, Paul, these are non-correlated assets. So sometimes one will do well and the other won't. But long-term real estate tends to appreciate over time. And if you get into it safely and you structure debt appropriately and you work with good sponsors, these things can all be mitigated. But those are the kind of things that I'm keeping my eye on right now, are supply and demand policy, or supply and demand, interest rates, and then administrative policy too. Obviously, we've got a new president in the office right now, and there's been a lot of changes that have taken place, proposed changes, but some have been enacted with tariffs and such and such. So there's still yet to be a conclusion as to what will unfold here. But I would just say, focus on the macro picture, the bigger picture, and always relate the headlines of today to what's happened in the past. History doesn't repeat itself, but it often does rhyme. And if you study financial history, you'll see this isn't the first time this has happened, and you can kind of relate what the outcome was during a past historical perspective to what's going on today. And I think that can keep you rooted and grounded. And commercial real estate's not going away.
Yeah.
Kind of rambled there a little bit, but that's what I'm keeping up with. You also asked me who I follow. Man, there's great people out there that are, offering a lot of different perspectives. There's people out there that are, trying to sell their potion too, but the people that I really pay attention to are the ones that do track the economy and look at the macro picture. Jay Parsons is a great guy to follow as it relates to rental housing. That could be single or multifamily. He's an economist. He does a great job of, kind of breaking down and analyzing market-specific situations and how it relates to the economy today. James Eng is another guy that I follow. He's with a team over at Old Capital. They're lenders, but he does a lot of analysis on capital markets and where debt is trending based on interest rates and what borrowers are doing in the space. So those are two guys. Greg Willett is another guy who's an economist who is with RealPage, who is very insightful and breaks down information. And then I read MarketWatch a lot, marketwatch.com, which is more for the stock market investor. A lot of their headlines are, but they do cover the economy quite a bit. And if you can gauge where sentiment is at and what's happening in a national and global picture, it just gives you more data points to make decisions. So that's a good website for that.
Yeah. That's great stuff, Paul. Really great stuff. And as a developer, we look at a lot of the same information, and I think you and I talked about it on the Passive Pockets deal review. One of the things that we saw in where the market was trended in 22, 23 was the drop in demand and the fact that there was a lot of supply that started into the pipeline in 20 and 21, but we felt like rates and the environment would slow development. And that's why we launched our first fund when we did in late 23, early 24, really anticipating that demand would have a level of consistency to it, and that with a drop in supply, it would create an opportunity for us and for our investors. And we've seen exactly that. Today in self-storage, the pipeline of new deals coming online is dropping below 3% of current inventory for the first time in probably the last 8 years, as development has slowed and demand sort of stays fairly constant. So, but absolutely kind of putting your finger in the wind and listening to smart people like you is a good guide to know when the opportunities exist and when it's time to be a little bit cautious, for sure.
That's right. So maybe the last question or kind of closing out this conversation, Paul, Paul, Shannon, do you have any recommendations or advice or wisdom, in addition to what you said, for high net worth individuals who are looking to get into real estate, maybe for the first time, or maybe trying to suss out if this is something where they'd like to place or allocate a part of their portfolio? Is there something that you would recommend that they do, they read, they analyze something? I mean, what would you say if you had to talk to hundreds of people on stage right now? What would you say?
Great question. I could tell you what I did wrong first, and then kind of how I found my way. I tried to go at it alone. I was in a sales career and was in the operating room selling capital equipment to surgeons, and spent a lot of time on my feet and a lot of time talking and networking and meeting people. And when I left that career, I was renovating single family homes and multifamily properties. And I needed a break from all that. I just wanted to kind of be on my own and be a project manager and be a real estate investor, right? And what I didn't realize was key to being a successful real estate investor, and that goes for passive investing as well, is that networking piece. You got to have it. I mean, you really do. And you have to know people. You have to know who to call when certain scenarios arise. That's where it's not as passive as I think it sometimes gets credit for. But how can you make it a little easier? It's joining a community. It's joining a group of like-minded individuals that share the same desire to create passive income, to create generational wealth, to kind of step into the alternative asset or commercial real estate, passive investing, private equity space, whatever you want to call it. It's not as simple, like you pointed out early in the conversation, Paul, is going down to Fidelity or Vanguard and talking with a financial advisor who's going to give you that traditional advice of, hey, let's allocate your portfolio into 60-40, and let's look at the 60 and break it into mid cap and large cap. And it's like, okay, that's pretty generic advice. So if you're looking for alpha, if you're looking to break away, create true diversification and outsize returns, where do you turn to? So it's usually from other people that have been in the space and been there and done that. And I found that the Passive Pockets community for me has been that outlet. There's other communities out there that are similar and maybe take a little bit of a different spin or approach, but there's nothing more powerful than being exposed to an opportunity that hits your inbox, or you hear about on LinkedIn, or you're pitched to by somebody else, where you can go onto a forum on a website and type in that person's name or that group's name and see if anybody else has had experience. You'd be surprised. There are people that have, and it's either good or bad. And you can find out a lot of information. If it's good, that would lead you down the path to say, hey, this meets my risk tolerance and my investment objectives, and I'm going to take a chance with this group and invest. Or you might find out that, that group hasn't been good at communication, or they're losing money on a couple deals, or, the worst outcome is that they're a fraud or something like that. You can save your capital. And, if you don't have that community to fall back on, you don't have that as a resource to then get that additional information. You just have to make, basically decisions inside a bubble, which is never good. So I remember passively investing in a deal early on, and I did it all on my own, and the outcome wasn't that good. So that community, I think, is key. And then, getting that pipeline filled. I think it's helpful to be an active operator, to be a passive investor, for sure. I can't deny that. But there are plenty of people that are passive investors that have never dealt with the tenants, termites, and toilets that are very successful in the space. And I think how they become that way outside of the aforementioned community is just by looking at deal after deal after deal, right? You don't know what a good deal looks like. I made the mistake, another one, of thinking that the private equity real estate space was really small. And when I got a couple of opportunities into my inbox, I thought, man, I really got to jump on these. These are once in a lifetime, so to speak. That's what they were advertising anyways. That's what everybody advertises. So when you realize after being in the space for a while that the space is really, really vast, it's large. And if you say no to an opportunity, even if it's a good one, there's going to be another one that comes down the road shortly thereafter. So I like to, consistently get emails into my inbox and have deals to look at, and then get competent by understanding how to evaluate them. What do the returns look like projected? Are they realistic? Can you look at an underwriting or Excel file and kind of break down what the inputs were? that were used to derive at the outputs, i.e. the projected returns. Are those inputs realistic? You start to understand these things the more deals you look at it. Read a PPM, the private placement memorandum, and understand some of the terminology that's used in there and some of the commonalities across these PPMs. And then you'll be able to identify some oddities that you might see in a PPM that are a little bit different than what the norm is. And you ask the sponsor questions about that. Or maybe you don't, and you just say, you know what, there's a risk I see. I don't understand it. I'm not going to invest in something I don't understand. Good enough. So there's always going to be more opportunities to invest. There's always going to be more deals to look at. But I would say getting the reps in is critical outside of just joining that community.
Yeah. What great advice, Paul. And I would echo, we have had tremendous experience with Passive Pockets as a sponsor. And I've been super impressed by that whole community and the way Passive Pockets is serving the investment community by providing things like the deal review that you're one of the co-hosts of. And I think it's just great teaching people how to do that due diligence and how to look at a PPM and dig out some things that you might have stepped over. Speaking of Passive Pockets, I'll put in a plug for both of us. A week from this Friday on the 21st, the tables are going to be turned. You're going to be the moderator, and I'm going to be the guest, along with Paul Moore, to talk about self-storage in specific. So if you're listening to this and you're a part of the Passive Pockets community, stick it on your calendar and make sure you get the link to that webinar presentation next Friday. I don't know if we've got time for this or not, Brandon, but I want to give Paul a chance to talk for just a second about his InvestWise Collective, the fund of funds that I know is a big passion and focus for you. I think people would love hearing a little bit about that.
Yeah, I appreciate the opportunity, Paul. InvestWise Collective is a fund that we started back in 2023. As I mentioned earlier, we have experience operating multifamily, but we also were investing, me and my partners, passively in our own portfolios, and we were identifying good opportunities in other asset classes when multifamily was kind of having a little bit of a rocky road for a while there. At least we thought so, and we didn't want to invest in that property type. So we didn't want to stagnate, but we wanted to keep our capital in motion. And we created this vehicle to basically collaborate and share in due diligence and then pool our capital together. And we thought, well, why not, if we're all three going to invest in these deals that we find and identify, why not give our investors the opportunity to invest alongside us and kind of keep them engaged too and tell them what we're up to, even though we're not as active on multifamily right now. So we started that. Over the last couple of years, we found really good yield and opportunity in investing in real estate debt, so moving lower in the capital stack. And what I mean by that is basically we're acting as the lender through other funds that we're invested in. We're letting people borrow money to acquire real estate, and we hold lien to the property that they acquire and a first position stance or a second position in some cases. Where we get first priority of payment. We loan on low to leverage, where if the property declines in value, or if a worse situation happens where we have to actually take the collateral, take the real estate back, we're getting it at a value that we feel like we can liquidate it at and still be made whole or potentially even profit. So that's been a really good place to hang out. A lot of people have had a need or a desire for cash flow lately and haven't been able to find it in most places, and we're able to pay into the low teens on some of the deals that we're involved in. So that's been really good, and we can redeem out of those funds when we want to rotate into something more aggressive, which we're about to embark on acquisition. We're under contract on an A-class multifamily property. For the first time in 3 years, we're going to acquire a multifamily property. As I mentioned, the conditions are starting to change and things are starting to look more attractive. So we maintain the position that we can be general partners or limited partners in the positions that we take within the fund. But our main objective is preservation of principal, diversification, and obviously to help people grow their wealth through passive investing. So it's been a fun journey with InvestWise, and we're looking forward to a bright and long future.
That's awesome. And thanks for sharing that. I'm a big fan of fund of funds as a vehicle. So that's super exciting. Paul, I really appreciate you taking time to be with us today, Brandon. Thanks as always for leading and guiding us. And I'll see you, if not before, I'll see you in about 8 days.
Looking forward to it, Paul, and appreciate you and Brandon. Thanks for having me on today.
Thanks, guys, for being here. The two Pauls, appreciate your insight and expertise as always, and we'll see you next time.
Great. Thanks, man.